Hello, welcome to my channel. I'm a trader with years of experience. I use price action analysis to analyze the market direction before executing a trade every day. Recently, I built an indicator to give me trade signals based on my price action strategy. In this video, I will give a brief introduction of my strategy as well as an introduction of the indicator and the application of it. So let me give you a brief introduction of my strategy. This is a platform called Tradingview. I use this platform to show the chart and to do technical analysis on this market. So this market is an example that we'll be using in this video. The price of the market pumped from the bottom here in 2015 all the way up to the price of 160 as of January this year. So over the years, this is what I call the 3-year trend. So the 3-year trend doesn't mean that it lasts 3 years, but it means that this is a trend that I call the 3-year trend, and the trend went up all the way up to here, and it is still going up. It has not shown us that it is weakening. It has not shown us that it is going to reverse down. So on this platform, I don't have it doesn't show me, it doesn't give me an option to show this market in the 3-year chart. So what I can do is to show you the 12-month or the yearly chart, and the yearly chart shows that the 3-year trend went up from the bottom here all the way up here, and now it is making a correction. So how do we present the 3-year trend? The 3-year trend is usually presented by looking at the 3-year chart, which is a candlestick which represents the 3 years period of time, and within these 3 years there are fluctuation of the prices, and we can draw trends to show this 3-year trend. So this is the 3-year trend, which is also this candlestick over here, and within this 3-year trend we have fluctuation of the market, which happened for the 1-year trend. So this is the 1-year trend going up, down, and up. And I'm not saying that this is the end of the 3-year trend, because it doesn't show me that it's going to reverse down yet. Not yet. It hasn't confirmed that reversal. So within this 1-year trend, we can also see that it's not the best way. Hold on, bear with me. Within this 1-year trend, we have it's not the best way to show it. Within the 1-year trend, we have fluctuations of the market, which are the quarterly trends. So the quarterly market. So these are all the quarterly market. So what do I do normally? Normally, I would follow the trends that's going. I will flow with the market. That is very important to make sure that you are always in profit. You go with the market, you go with the trend, you follow the market direction. So the market direction for the 3 years, for the 3-year trend was going up, and the market direction for the 1 year was going up for this period of time. And then within the 1 year we have quarterly markets, okay, and the quarterly market fluctuated within the 1 year market. And if we understand these layers, these levels of the market, and we analyze each market and we combine all the markets together, then we have the market direction that we should follow. And if we trade in that market direction, then we have a very high probability that we'll make profit. The probability is very significant. So with that brief introduction of my strategy, I will give you an introduction of the indicator that I use to show that the condition of the market, and how to trade the condition of the market, how to follow the direction of the market. So I will show you the indicator now. And the indicator has a table, and this table shows the market direction of each layer of the market. Okay, so like I said previously, we have to follow the market direction. We have to flow with the market. So how do we do it? So for example, if the market is going up, then it would be best that we don't trade the direction that's going down. We want to trade the direction that's going up, because that direction means that we are following the market direction, we are following the flow of the market, and the chances of making profit is higher than the chances of making a loss. So with this indicator, I can show you the direction of the trend of each market. For example, if we go on the 2 months, the monthly, the reason why we can't see any direction on the 2 months or 3 months or 10 months or 12 months is because there is not enough data that's given to the indicator to study the market. So in this case, what the indicator can show you is signals or directions for the month on the monthly chart. So on the monthly chart, we can see that the quarterly trends on the quarterly market direction went down here, went up, went down, went up. We can say that this whole distribution and accumulation is for the 1 year trend, 1 year market. And then after this, we have the 1 year market following the 3 year trend that was going up. That's the 3 year market that was going up. This is the 1 year, and the 1 year made a breakout of this correction to follow the 3-year direction, which was going up. And after that, we can see that the quarterly came down, and so did the 1-year market. So the quarterly came down and the 1-year market came down, and with that we could be opening short positions to take advantage of this market going down. So for example, the quarterly market came down here, and we would want to wait for a market fluctuation in the trends in the market inside the quarterly market, which means the monthly and the weekly market. So when the monthly and the weekly market went up, we want to take advantage of that and open short selling position, and that would be the profit that we will be looking at. Normally what I suggest to my group members, to my students, is that we would want to only trade in the direction of the other market. So we want to combine the market layers together, and we want to trade in the direction that all the market layers are agreeing with. For example, if we know that the 3-year was going up, and we know that the 1-year could be making a correction before further going up, then we would want to wait till the right time to long the market. And with this indicator, we can see that the quarterly came down with the yearly until a point where the quarterly made a breakout. So at this point, the quarterly made a breakout, right? That breakout was the breakout of the yearly market. So in other words, this indicator can show us that the quarterly is breaking out, and that breakout can signify a breakout of this correction of the yearly market. So what do we understand from here? So this quarterly came down after making a breakout. So what could be happening? There are two possibilities that's not confirmed yet. One possibility is that, similar to the previous 1-year market, this market could be over, the 1-year market could be over, and with the market, with the 1-year market over, that means is a reversal, and which is signified by the quarterly came down once, went up, and came down twice. So if that 1-year market is coming down, then we can be thinking the momentum of the 3-year is slowing down. And will we see this kind of situation where the quarterly follows the yearly and come down to this area of support here before making a reversal, which will be the correction up to this area of resistance? And if it makes what we call a higher low, a lower high, if it makes a lower high of the yearly trend, So the yearly came down, and if the yearly went up to make a lower high of the yearly trend, that is the point where we should be thinking that the 3-year trend that was going up previously is over. The 3-year trend, the 3-year uptrend, it will be over when there is a lower high, and we should be thinking about short selling. We should be thinking about opening short positions from then on to keep selling, because that means the 3-year is going down, and then we'll have the yearly going down as well. And how would I trade this? When that happens, I'd be trading this following the quarterly signals. So the quarterly market signal will appear, and that's when I will be opening short seller positions to follow these layers, these levels of the market. This strategy can be used according to this your preferred desired period of holding period of time of your trade. For example, if you're longing only the quarterly trend and your period of holding is about 4 months, 3 months, 4 months, that you could be following the quarterly trend, the quarterly signals here on the monthly chart, the quarterly signal, and along this direction, this market direction that was going up. And then after that, you could be looking at this direction that's going down, and you could be thinking that we opened a short position over here and would be holding that short position over 4 months or 3 months, and we hold it all the way down here, 4 months. So 4 months will be around here, right? So it matches your desired period of trading time. Let's have a look at another example of using the of making intraday trades. So if I were to make intraday trades, then I'll be looking at probably 15-minute chart or 1-hour chart, and with the 15-minute with the 1-hour chart, then I would have this market layers going down. This is a market layer which I call the daily market layer. With the daily market layer going down, we have instances, we have examples of the 4-hour market layers going down as well. So the 4-hour market layer could be doing this correction and this and correction and this. Okay. And what we want to do is that we follow these market layers and we make the trade. So actually what we can see here is that beside the daily, we also have the market layer of 3 days. This one, let's call it 3 day. And the 3 day market layer was going down as well. So what we could be doing is that we analyze this market layer, the 3 day market layer. Oh, the 3 day market layer was going down, and the daily market layer was going down as well. And now the 4-hour market layer, when there is a signal that appears here, you'd want to open a short position to follow these market layers and to flow with the market direction, to go with the market direction, and just open short selling position and make profit. So what I want to say is that I think it's very clear that I showed you it is very clear that what my strategy is. My strategy is to follow the market direction, is to follow the price of the market. If the price is going down, if there's a lot of selling pressure, then we follow that market direction, and we distinguish, we differentiate the market into several layers, and then we analyze each layer before we're combining all the layers together again and execute a trade in that direction, right? So with the help of this indicator, we don't need to do a lot of that. What we can do is we follow this direction of the signal, which in this case it says that the market direction is going down, and we follow the market direction. We execute our operation or execution strategy, which means if we open a short position here, then we put our stop loss. We can put our stop loss here, which signifies the break of structure before taking profit at this big price movement, at the end of this price movement. All right, and then again we wait for a correction of the 4-hour market, and this is the correction. And when the correction is over, when there is a signal, we follow that signal. If the signal appears here, for example, we wait until the signal is over and the market below the 4-hour made a slight correction, which is the 1-hour correction, then we short the market again. So now we have an option. We have option to put our stop loss above the candle where we enter the market, and when that candle is broken, when the price went up above the candle, there's a break of structure, which means that our the direction of our entry, the market is in the opposite direction, is going in the opposite direction of the direction of our entry. So which means we put our stop loss there and we trade the 4-hour market all the way down until there is a big price movement, which is this stretch, and we take our profit. Okay, similarly we'll see another correction of the 4-hour market, and after the correction we have break of structure of the 4-hour market and the signal appears, and we put our short order after a slight correction of the 1-hour market, the market below or within the 4-hour market. And then for this example, there is no big stretch of price movement. or we could say that the price movement, that there was a big price movement coming down from the top here all the way down here, and if we don't take our profit there, and we see that there is a break of structure over here, which means there's a reversal of this 4-hour trend, then we should close our position, whether we are in profit or we are in loss. But in this case, we are in profit, and if we close our position on time, we are in profit. And if we close our position on time at about, let's remove this here, we are still in profit. Okay, these gray signals are the exit signals. So which means if you rely solely on trading signals and you don't make your own technical analysis or price action analysis, and there is this kind of situation where you enter here and the market reverses, the 4-hour market reverses, these trade signals will tell you that this market is reversing, and you should close your position whether you're in loss or whether you're in profit, and wait for the next signal to open a short again or to open a long. In this case, the market went sideways, made a reversal of the daily trend, the daily market. So the daily market made a reversal. It is still in the middle of making a reversal, so there's a period of distribution, or don't call it distribution, a period of indecision before the daily is making a clear reversal over here. Break of structure, basically this is the daily break of structure. So with that break of structure, the daily was going up, and the 4-hour, we will see the 4-hour going up, and we will see the 1-hour going up. So what we could be doing here is we follow the 4-hour signal and we long with that signal. So if we follow the 4-hour signal, we want to know that this direction is what the market is telling us is what the direction of the market is, the flow of the market. The daily is going up, the daily was going up, the 4-hour was going up, and each candle of this represents 1 hour trend, which we can see over here. This means a 1-hour chart, and on the 1-hour chart we can see the 1-hour trend going up. Then we see a 4-hour signal before the 1-hour trend, and coming down to make correction and reversing up again. So if we make a long position here with the stop loss here, we would hit our stop loss because the market made a correction. That doesn't mean that the signal is wrong. It just means that the market made a correction and we entered at the end of the trend before a correction happens. So that stop loss was hit, and we enter here, we set our stop loss here. Yeah, we suffered a bit of loss, 0.46%. Before we analyze the market again, we wait for the signal, and when the signal appears, the 4-hour signal appears, we simply enter again right over here, and we can set our stop loss here, or we can even set up stop loss here. It depends on what is your risk tolerance. Yeah, if you have a 1% or 2% risk tolerance, then this is very suitable for you. So we then hold our long, we open a long position and we hold our long position until this whole 4-hour trend is over. So normally I would call that this 4-hour trend is over, but we follow the signal. The signal came out as soon as there's a breakdown here, because there was a breakout within the same candle, and the 4-hour trend continued up all the way here until we see selling pressure over here. So this selling pressure is for the 1-hour trend. So when we see selling pressure and the trend, yes, the 4-hour trend reverses down. Actually, the 1-hour trend reverses down. We should be thinking whether this is the end of our 4-hour uptrend. So normally I would draw a trend line, and when there's a breakdown of the trend line, I would close, because I would be making profit already. If you don't close, if you rely solely on the signal, then you'd be holding, you'd be holding this position all the way up to this point, okay? So at this point, this exit signal will tell you to close your long position, because there's a break of structure and there's a clear breakdown of the 4-hour uptrend, and you should be closing your position whether you make profit or not. In this case, we made profit. So that's for intraday trading. If we follow this table right here, like I told you just now, we have a yearly trend. We have a yearly market that's going down. We can go to the yearly market. We can go to the monthly market, monthly chart, to have a look at the yearly, quarterly, and the monthly. Then we can go to the daily chart to have a look at the monthly, weekly, 3-day, and daily. And we can see that all the market are showing red, which means the market are going down. The markets, several layers of the market are going down. If we look at the 1 hour, we can see several layers of the lower time frames are also going down. So in this case, what we want to do is we want to keep observing the market and keep anticipating to enter in the direction of the market going down, which means we want to open short positions. So without analyzing the market by yourself, this indicator tells you that the several layers of the market are going down, and you could be expecting when they're all red, then you follow the direction going down. You want to open short selling. You want to open short position. So let's do another thing. Let's label each layer market. correction. Yeah. Let's analyze the market and by ourselves without depending on the indicator. For the three-year trend, it is not confirmed that this 3-year trend is reversing down. We can see that the momentum is dying up here, and which means that the pump is getting slower and less. It's decreasing. So the 3-year in this case is still going up. The 3-year trend can last more than 3 years. I would say 3 to 9 years actually. So I call it 3-year because there is no name for it. I call it 3-year because on the 3-year chart, this market direction is shows that it is going up. So that's why I call it 3-year trend, 3-year market. So for the 3 years going up. For the 1 year, let's see. The 1 year is going down. The indicator can't tell you that the 1 year is going down because there is not enough data. So usually if we look at the 2-month or the 3-month chart, then we can see that there's a signal for the yearly going down. But because there's not enough data of the market, so it needs to be longer. If there's enough data over here, then the indicator will tell you that where the yearly is going, whether the yearly is going up or the yearly is going down. But from my manual analysis, I can tell you that this yearly trend is going down, and this yearly trend, which is this trend, this whole trend is going down. So now after the yearly, we have a market layer that's inside the yearly market, which is the quarterly market. And the quarterly market, we have signals telling us that the quarterly market is going down. So we know right away that the quarterly market is going down. And after that, we can go to the weekly to show us the monthly trend or the monthly market. And in this case, the monthly market is going down. There is no sign that the monthly market is reversing up. So at this moment, we say that the monthly market is going down. And after the monthly market, the market inside the monthly market is what I call the 3-day or the 2-day market, and the weekly market. The weekly market was going down, and then it made slight distribution in this area, slight correction in this area before a signal appears and shows us that this weekly market is starting to go down again. Okay, so right now the weekly is starting to go down again, and with the weekly going down, we can see that the 3-day market is going down, with the 3-day going down, we want to check whether the daily is going down or not. The daily right at this moment, it is showing that it is going down. But I can tell you that we've seen a lot of movement for the daily market, and what I expect is that I expect the daily to make a slight correction before moving further down. Alright, so if that happens, so what do we do here? Like what I showed you previously with the 4-hour market, if we short here, if we open a short sell position with a big movement, big price movement like this, I would take my profit. Yeah, so with that profit taken, I would wait for a correction. A correction can happen right here before entering the daily signal, with the daily signal going down again, or the correction may not happen until later on. Okay. So the daily may continue down a bit more before making a correction and before it goes down further. But what's important is that we take our profit. So we enter here, sorry, it's a short position. Short position, we set our stop loss here, we take our profit over here, and we wait what the market tells us. So the market may do a bit of correction, or the market may continue down before making a correction, and we enter the market again when there's another daily signal coming out. That's why this indicator is called a trade signal indicator, because it tells us what the market is doing, whether it's time to enter the market, to enter a trade or not. So let's continue with our market direction. So with the 1 day going down, I think we have our 4-hour. 4-hour market is inside the daily market. The 4-hour market, as you can see, I call it a 4-hour market because on the 4-hour is the shortest direction that the market is making, and we can see that clearly when we go down one layer below it, which is the 1-hour chart, and we can see the 4-hour market that is a stretch from here all the way down to here, and then a slight correction of the 1 hour and going down further. So that's the 4-hour market. And the 4-hour market is showing a slowing down momentum, and what it could be doing is that it could be reversing up, or it could still go down. There's no confirmation. If I don't rely on the trade signal, what I would do is that I would short this position. I would enter a short position. I would enter a short position here with our stop loss here. So there's a break of structure at this point, and that's where we put our stop loss and our entry and our stop loss. And I'll take profit. So the take profit is supposed to we are supposed to use the take profit from the previous market movement. So the previous market movement was from this stretch, which is about 1.8. %. So we can safely say that the market could be moving down 1.8, another 1.8%. That's our take profit for our entry over here, right? If the market reverses, then we'd hit our stop loss here. If the market moves down, then we make profit. In this case, we followed our strategy. The strategy showed us that the market was going down. Several layers of the market was going down, and we follow that direction. We follow that market flow. If that fails, we hit our stop loss. But we should look at it in this way. We already made profit from the previous drop and another drop. And if this drop is not successful, we hit our stop loss, and there will be a break of structure. A break of structure when this price is broken, which means when the price increases beyond 122.2. Okay, I think we should stop our market direction analysis at the 4 hour. So the 4 hour is still going down, and I will put an up sign here. So it's not decided. It could be the end of the downtrend of the 4 hour market, or it could be a continuation going down further. So we are not sure, and we can't decide at this point. Okay. So as a summary, I think what I want to tell you is that this is my strategy. My strategy flows with the market. My strategy analyzes, determines the direction of the market, and my trade always follows the market direction. If the market direction is going down, we want to follow that, and we want to trade in the direction going down. If the market direction is going up, then we want to trade with the direction going up. It's simple as that, and it is a matter of analyzing each layer of the market and combine all of the layers into one to understand the market as a whole. And if you don't want to do that, if you think it's time consuming, then we have this indicator to tell us what the market is doing right now. So the market is right now going down, with the monthly going down, with the quarterly going down, and it is safe to say that we keep entering short. Okay, this signal is as simple as that. If you want to follow this gray signals, they are exit signals. It means that if you short using the signal of this 3-day going down, then you enter your short here, and you keep shorting all the way down until the gray signal tells you to stop. The market is reversing, and you want to take your profit. So you take your profit, you close it in profit, and you don't want to long, you don't want to enter long, because the overall market flow is still going down. So what you want to do is that you wait for the correction, and when the correction is over, you go short again. Yeah, you short again until the gray signal tells you to stop shorting, and the market makes a bit of correction, and you enter your short position again. So that's how we make profit. It's not very difficult, and the indicator further helps you to make it look easy. Okay, thank you for your attention, and I hope you understood my explanation. If it's not clear, please contact me. Thank you.